If you find an accountant to assist you with setting up the SMSF and you have to sign 3 inches thick of paperwork, that's probably going to be a planning scenario where you're paying not only an accountant, but a connected financial planner to give you advice on what to do with the funds. That's a bit of a red flag.
Hello and welcome to the Solve2Evolve Podcast. I'm Jono Wilkes, Director of Solve Accounting, and I'm joined by Chris Bloxam, Founder and Director of Solve Accounting.
Hey Jono, pleasure to be here.
Likewise, and today we're talking about the top 5 things to consider before deciding to set up an SMSF. So we see this a lot in practice, and I think it's something we should address. So the first point is to start with, I think it was Simon Sinek says, start with why. And before you even think about setting up an SMSF, you want to have a strong reason for doing it. And whatever that reason is, it's going to be personal to you because it's your personal retirement vehicle, it's your personal wealth vehicle, and it's something that you're going to have to maintain for potentially 20 to 30 years. So if you're setting one up in your 40s, you can't access it typically until around your 60 or 65. So you need to be along for the ride and have a long-term vision. Some of the examples as to why people might set up an SMSF, they really want to take control and responsibility of their finances. So, you know, that they're very self-driven, self-directed, maybe a business owner as well, and you want to take control of your retirement rather than outsourcing that to retail or an industry fund where it's just kind of left there and forgotten about. You might also have some issues with the way that the market is set up with retail and industry funds. Obviously, they're massive super funds. There's been recent regulation which has forced a lot of them to amalgamate in a lot of cases. And I mean, I don't see it as a good thing, just my opinion, but that seems to me there's less competition in the market for people's retirement funds. So, I mean, over a long term, I think that provides worse outcomes and skewing the power. I mean, you might also want your why might be growing your investment knowledge. So, I mean, if you start an SMSF in your 30s or 40s, don't you think that after investing and acquiring all that knowledge, I mean, Blox, you've done this yourself, but acquire that investment knowledge, that's something that can't be taken away from you. So I think that's a strong reason. Another reason might be ethical investing or for ESG type reasons. And you can cut that either way. You know, there's some people are not happy with how the big super funds are not divesting fast enough from fossil fuels and things like that, in their opinion. You could also take it the other way and think, well, I don't see a problem with investing in coal because it provides power, provides energy to people. So you might want to get out of those ESG type mandates and invest in accordance with your beliefs. So these are all strong reasons.
A reason I often see, Jono, is if a small business person has a need for land, they can buy land through your super fund in a leveraged way, and you can actually park that land inside the super fund, so with debt. So that can actually extend your ability to invest more through super, and it gives you control over the rental income. So you can kind of, to a certain extent, you can shift profit from one entity, your business operating entity, into your super fund, and that appeals to a lot of people. But I really agree with that the first point in that you have to reach when doing a SMSF or considering a SMSF is why you're going to do it. If you don't understand why, you should probably just sit tight for a little bit.
Yep, spot on. So the second point of you should consider before starting an SMSF is strategy. So I think it's really important to think about that before you get and start down the path of an SMSF. That's going to depend really on your investment experience. So if you're someone who doesn't have much experience, you might want to go down the path of consulting with a financial advisor, before you open the fund itself. Always a good idea just to give you that comfort and get you the strategy that you can then implement with the SMSF. I've seen it in practice. A few times clients get all excited and they see certain websites you can set up SMSF for free, but I feel like there should be a threshold before you get involved. And having that investment plan that needs to be thought about first. So just to be clear, obviously we're accountants, so we can't give financial advice. So we don't give that advice directly to our clients, but we have people in our network that we introduce them to provide that strategy advice. And also on that point, I'd say know what investment classes you want to invest in. Like if you're interested in shares and, you've YouTubed franking credits, how franking credits work, or you've listened to our podcasts, then you might really like the idea of investing in Australian shares through an SMSF, and you already know that. So, that might narrow down the choice of financial advisor you choose to work with. There's alternatives in the market. For example, we had Mitchell Stone on the podcast. He just focuses on share market advice, but it's general advice. Overall strategy and asset allocation is going to be. When I was going to say, like I often see on the investment strategy document, listing every asset class and just having 0 to 100% as the allocation, and then it's signed off by the trustee. To me, that's not an investment strategy. It's not worth the paper it's written on, so keep that one in mind. Number 3 of the top 5, I think, are contributions. So before you open an SMSF, you need to be in an overall financial situation where there's going to be regular contributions, the capacity to make regular contributions to the fund. If you can't make those regular contributions, it's not going to be an effective investment vehicle. So it depends on your situation. I mean, for example, the simplest case is you're an employee or you're an executive. So you've got your employer's taking care of those contributions because they have to. The other one where it's a bit more complicated is if you're a business owner or director, you're going to want to make provision for those contributions, and you're going to have to make them out of your personal funds. So that might feel a little bit different because it's not a company funding those or an employer, but that's something you're going to have to take account for and make sure you have the capacity to do that before setting up the SMSF. There's no point setting up the SMSF when you're in the first few years of business. You haven't built up profits, the regular drawings to be able to make those contributions.
I totally agree. And that kind of leads into my fourth point of the top 5 points when considering setting up a SMSF, which is that simplicity is king. With the contributions side, you have to be sure that you can make regular contributions, but then back to Jono's, the second point, which is your investment strategy. If your strategy is not simple and understandable, even if you're making those contributions in, you might freeze when the cash hits the bank account and become paralyzed by over-analysis of so many different options that you can invest in. The simplicity of your investment approach is really one element of simplicity that is really critical when wanting to set up a SMSF. You cannot be doing things that are too complex because it can quite literally, I've seen a lot of times that people roll cash into a self-managed super fund after we've established the bank account, and the cash just sits there while they're waiting for something else to happen. It's not the way to, the universe won't reward you. Simple investment plan that they can action straight away as soon as the cash is rolled in. I'm just going to buy the market, buy Telstra shares and dividend reinvest and forget about the market. Or I know that I'm going to buy that storage shed over there for my truck because I need to park my truck in it overnight for safe, secure storage. It's a business asset, so it's an exception to the in-house assets rule. So that if people who know exactly what they want to do it and why they want to do it, the why is the first point as well, and who keep it simple, they're the ones who succeed in the SMSF environment. Without a clear and simple path, even if they do make regular contributions, which they unlikely will, they'll just sit a chunk of cash there and wait. Headlights, they're the funds that underperform, and they're the people who probably should not have become SMSF trustees in the first place. So that comes back to kind of being honest with yourself and making sure that you have a plan and that it's a simple plan going in. But simplicity so relevant to other things when setting up a SMSF. So, for example, the engagement terms. So if you find an accountant to assist you with setting up the SMSF and you have to sign 3 inches thick of paperwork, that's probably going to be a planning scenario where you're paying not only an accountant, but a connected financial planner to give you advice on what to do with the funds. That's a bit of a red flag, because to a certain extent, which is my final point, to a certain extent, a self-managed super fund needs to be managed by yourself. I know, the clue is in the name. It's a literal reading of the name. If you are setting up a self-managed super fund, you have to be prepared to manage it yourself. So in documentation for an account administrator, which is what we are, we're not auditors, we administer the funds. So accountants typically administer the funds. By law now, we have to outsource the auditing to an arm's length party. And every firm has to do that. You can't audit your own work anymore. There was a time when you could have a SMSF auditor within your firm. Those days are gone because of a number of problems that it was cleaning. So if you're signing joining documents that are too complex and too long and you don't understand them, again, simplicity is king. If it's too complex, please reconsider it, or at least consider it very carefully, not you understand it. Final element of simplicity is accounting and tax compliance documents going forward. So when you're engaging with an administrator, for example, like our firm, you should ask to see an example of the documents that are produced at the end of every year so that you understand what the compliance package will look like. And if that compliance package contains a whole heap of reports and estimates of return and various pie graphs and bar charts that you don't need or understand, then the chances are that your fees are going to be higher than what they have to be, and that you're paying for something that you may not necessarily get any value out of. So there's a ton of accounting packages out there that, I won't name any specifically, but they produce a ton of standardized reporting and documentation that you may not need if all you're doing is buying shares in a company on the ASX and dividend reinvesting, for example, a bank. You don't need compliance documentation every year. So if you're paying for accounting packages that you don't need, ultimately that will hurt the returns on your investment.
Yep. I think that's a good point, Blox. And, if you do get those reports, you need to be able to read and have some level of understanding, and your accountant should be able to explain them to you and help you read, especially in the earlier years as you're gaining that experience. I think that's an important point. So just to sum up, I think setting up a self-managed super fund is a choice to self. This podcast is not financial advice. You want to start with the end in mind. And if your end is to have a nice retirement, a nice pension that you have control over, not to have to rely on the government, then this could be a good vehicle for you. You can't have more than $1.9 million supporting a pension. And a pension is tax-free in Australia once you reach pension age, which is typically 60 up to 65. So the goal is, you should never want to have more than that in your super fund, ultimately, because it's not going to be tax-free when you start to draw on it. So, my goal start with the end in mind is to have at least $1.5 to $2 million by the time I'm at retirement.
That's per member as well.
Yeah.
So it's not $2 million in the fund. If you have a husband and wife in the fund, that's $4 million or $3.8 million. If you have husband and wife and then the kids hit 18 and want to start working and there's 3 of them, then there's another $6 million that you can chuck in. And the reason why we're hanging around the $2 million mark is because of legislation isn't in force yet. There's Division 296 of the Tax Act is going to cause problems for people who have over $3 million in their account. There'll be taxation on unrealized gains. So that's the reason why we're talking about kind of pulling up stumps at 2 million, which is a transfer balance cap at this point in time, but that will change over time. So if you're looking at this several years into the future, these numbers may have changed. But yeah, and you should consult your accountant or your administrator to advise you.
That's great, Blocks. So just quickly to sum up, number 1, start with why. Number 2, investment strategy. Number 3, contributions. Number 4, simplicity. And number 5, be prepared to manage it yourself. That's all we've got time for today. Please join us next time for the Solve2Evolve podcast. And in the meantime, if you want more information, please visit our website or email podcast@solveaccounting.com.au.